Last week, a 26-year-old named Alex downloaded a stock trading app for the first time. She stared at the screen for 20 minutes trying to figure out what she was actually buying. Numbers flashing everywhere, red and green, percentages changing every second. She closed the app and thought maybe investing just wasn't for her. This video is for Alex and anyone else who thinks the stock market is some impossible system you need a finance degree to understand. It's not. Once you get past the jargon and the theater, it's actually pretty simple. Let's start with what a company actually is, because if you don't understand this, nothing else makes sense. Think of any company as a basket, just a basket. Inside that basket is valuable stuff. Some of it is physical. If you're looking at Ford, there are factories, trucks, machinery, buildings. You can touch these things. Some of it is intangible. Ford has a brand. They have a reputation built over 100 years. People trust that name. That trust has value, even though you can't hold it in your hand. Take Nike. Yes, they own warehouses full of shoes, but their real value is the swoosh. That logo is so powerful, people will pay triple the price for the exact same shoe manufactured in the exact same factory just because it has that symbol on the side. The basket contains both physical assets and intangible value. Everything a company owns and everything a company represents. That's what you're actually looking at when you look at a business. Now here's the question nobody explains clearly. Who owns this basket? And more importantly, how do we decide who gets what's inside it? Imagine you're a mechanic. You've been working for someone else for 5 years and you finally saved up $15,000. You want to open your own shop. That's great. Problem is, $15,000 isn't enough. You need equipment, you need a location, you need inventory. So you go to your cousin Sarah and you borrow $15,000 from her. She agrees, but only if you pay her back with 6% interest. Now you have $30,000 total. You rent the space, you buy the equipment, you stock up on parts, you open for business. 1 year passes, your mechanic shop is killing it. You're fully booked every day. You want to expand into 3 new locations across the state, but you need a lot of cash to make that happen. You could borrow it, but that would mean more debt and bigger monthly payments eating into your profit. Instead, you decide to do something different. You're going to sell pieces of ownership in your business. Your friend Marcus buys 10% for $20,000. Your neighbor Lisa buys 5% for $10,000. A local investor buys another 10% for $20,000. That $50,000 goes directly into the business, and now you can afford the expansion. This is called an initial public offering, or IPO. It's the moment a company sells ownership pieces to the public for the first time. The money from that sale goes to the company to fund whatever they need. After the IPO, something important changes. If someone who bought ownership wants out, they don't sell back to the company. They sell to someone else. So 1 year later, Marcus decides he needs his money back for a down payment on a house. He sells his 10% ownership to someone else. That buyer pays Marcus directly. Not you, not the company, just Marcus. It's exactly like a used car. Toyota gets paid once when the dealership buys a brand new Camry. After that, the car changes hands 5 times over 15 years between private sellers and buyers. Toyota doesn't see any of that money. They got paid once. Same with stocks. After the IPO, shares just circulate between investors buying and selling from each other. And that circulation is what we call the stock market. You've heard of Wall Street, the New York Stock Exchange. It used to be hundreds of people in suits on a trading floor shouting prices and waving papers. Today, it's almost entirely digital. It's apps on your phone, Robinhood, Fidelity, Charles Schwab. You tap Buy Tesla, someone in another state taps Sell Tesla. Your accounts adjust, and now you own a tiny piece of that company. Every single day, trillions of dollars move this way. Not going to companies, just people swapping ownership stakes back and forth like trading cards. Wait, if the money isn't going to the company, why would you want to own the stock at all? 2 reasons, and both of them put money in your pocket. First, the stock price might increase. You buy a share at $75, 2 years later it's worth $150. You sell, you just doubled your money. The company didn't pay you anything directly. The value of your ownership stake simply went up because other people were willing to pay more for it than you paid for it. Second, some companies distribute cash directly to shareholders. These are called dividends. Let's say you own 200 shares of a company. The company announces a $3 dividend per share. You get $600. Posited into your account just for being an owner. You didn't have to do anything. The company made profit, decided to share some of it, and sent you your cut. Companies like Coca-Cola and Procter & Gamble do this consistently every quarter. Others, like Tesla and Amazon, don't pay dividends at all. They take every dollar of profit and reinvest it into growth. Why the difference? It comes down to what the company thinks is the smartest use of cash. A company like Coca-Cola is already everywhere. They're not going to suddenly triple in size. Growth is slow and steady, so they take the profit and return it to owners. A company like Amazon looks at that same cash and thinks, we could hand you $3 per share, or we could use that money to build 15 new distribution centers and double our delivery speed. They choose growth. Neither approach is wrong. It's just a different strategy. Mature, stable companies tend to pay dividends. Fast-growing companies tend to reinvest everything. As an investor, you profit either way. Either the stock price climbs or cash hits your account, or both. But regardless of dividends, everyone watches one number obsessively: the price. So why do stock prices move up and down, sometimes wildly within a single day? Supply and demand. That's the entire answer. When more people want to buy than sell, the price goes up. When more people want to sell than buy, the price goes down. A stock is worth exactly what someone else is willing to pay for it right now. Nothing more, nothing less. But that just raises another question. Why do people suddenly want to buy or sell in the first place? Because they're making bets on the future. Apple announces a new product category that looks revolutionary. Investors think this is going to generate billions in new profit. They buy. Price jumps. A pharmaceutical company reports that their main drug failed clinical trials. Investors think revenue is about to collapse. They sell. Price drops. NVIDIA says they're building AI chips faster than expected. Stock rises 15% in one day. Sometimes the moves are based on real financial data. Sometimes they're pure emotion and speculation. Sometimes millions of people panic simultaneously because of a news headline that turns out to be wrong. Every piece of information affects how investors feel about the future, and how they feel about the future determines what they're willing to pay today. Earnings reports, economic data, Federal Reserve decisions, geopolitical events, product launches, executive scandals, all of it feeds into the collective perception of whether this company will be worth more or less in 6 months, and that perception moves the price right now. Okay, so you understand companies, you understand ownership, you understand how the market works. Now, what should you actually do with this knowledge? Here's the approach backed by decades of data and recommended by people who've studied this their entire careers. Don't try to pick individual winning stocks. Don't try to time when to buy and sell. Professional fund managers with entire research teams and decades of experience can't consistently beat the market averages. You probably won't either. That's not an insult, it's just statistics. The vast majority of people who try to pick stocks underperform simple passive strategies. Instead, buy a little piece of everything at once. There's a product called an index fund. It's a single investment that holds hundreds or thousands of companies simultaneously. You make one purchase and you own tiny fractions of Apple, Microsoft, Google, Amazon, Walmart, Johnson & Johnson, and hundreds more. The most common one tracks something called the S&P 500. That's the 500 largest publicly traded companies in America. When you buy an S&P 500 index fund, you effectively own a small piece of the entire U.S. economy. If the economy grows over time, your investment grows with it. I'll be honest, this strategy is boring. Nobody's going to be impressed at a dinner party when you say you invest in index funds. There's no story, no thrill of picking the next Tesla. But here's what actually matters. Over the past century, the S&P 500 has averaged roughly 10% annual returns. Some years it's down 20%, some years it's up 30%, but across decades the trend is consistently upward. Put money in regularly. Don't panic and sell when it drops. Just wait. Time does the heavy lifting. That's how regular people with normal jobs build 7-figure retirement accounts. Let's recap everything. A company is a basket containing valuable assets, both physical and intangible. Stocks and bonds are two ways to fund that basket. Bonds are loans with fixed returns and lower risk, paid first. Stocks are ownership with unlimited upside, but higher risk, paid last. When you buy stock, you're almost never buying from the company itself. You're buying from another investor who's selling. That exchange between investors is the stock market. Stock prices move based on supply and demand, driven by collective bets about the future. You profit from owning stocks in two ways. The price increases, or the company pays you dividends, or both. And if you're just starting out, the smartest move for most people is buying index funds and letting time compound your returns. Alex opened the app again. This time, she knew exactly what she was looking at. She wasn't gambling. She was buying small pieces of businesses. She wasn't trying to get rich overnight. She was building wealth the way it's actually built. Slowly, consistently, patiently. The stock market isn't complicated. It's just been explained badly. Now you know better.